Welcome to another episode of A Quest for Twice. Today is November 14th. I'm going to cover a few earning updates from my portfolio. The first one is Amazon. Amazon just finished its fiscal 2023. So in the latest quarter, its sales grew 5% underlying. That's driven by price increase of 4 percentage points. So mostly driven by price increase that shows the wide moat Amazon has. All world areas had a positive growth. And backlog now is at 6.6 billion, slightly reduction from end of fiscal third quarter, but up 12% from 1 year ago. Its adjusted segment EBITDA has a margin of 25.5%. That's 80 bips increase from 1 year ago. That's driven by its operation leverage about 45%. As I just mentioned, it's driven by strong price. In October, it closed the deal to buy NI for $8.2 billion to beef up its discrete segment. Interestingly, if we look at the segment revenue by quarter in the graph on the top left, you can see that that's really the only segment had negative year-on-year growth. Last year, the segment revenue was 718 million, and this year it was 666 million. Other than that, the other segments grew nicely with a healthy increase in the EBITDA margin. So in the last 18 months, Amazon has been busy buying and selling businesses. So it sold about $18 billion of its old legacy business and spent $18 billion to buy new business. So with all that settled, I'm ready to look at its valuation level. So Amazon owns 50% of Aspen Tech, which is publicly traded. So we know its market cap is 10.6 billion at $167 per share. That gives $6 billion of equity for Amazon's ownership. So at $86 per share for Amazon stock, its enterprise value is about $50 billion. Then the core Amazon, excluding Aspen Tech, would be 43.5 billion enterprise value. So in this year, its EBITDA is $3.4 billion excluding Aspen Tech. So we can calculate the core EV over EBITDA ratio, and we get about 12.7. So if Amazon sell the same amount of stuff next year, but keep on its price increase, its EBITDA margin will increase, and its revenue will increase, and its EBITDA will increase as well. So in my opinion, 12.7 is an attractive price. I believe at this price point, Amazon is slightly undervalued. Now let's look at Upstart. So Upstart had explosive growth from 2018 to 2021. Then the Fed increased the interest rate in the last 18 months. That really put a brake on Upstart's revenue. So last year, it actually had a slight revenue decrease from 2021. On a quarterly basis, its revenue peaked in the Q1 2022 at 310 million, then start to decline from there. In the first quarter this year, the revenue was about $100 million, but rebounded to $136 million in the second quarter. And in the third quarter, its revenue was about the same as the second quarter, with the same amount of transaction volume. So can it grow again? In the most recent quarter, the conversion rate was 10%, slight increase from the first half of this year. That's driven by the higher interest rate, make loans less affordable, and fewer borrowers eligible. In the recent quarter, it made $29 million of revenue in the automobile segment. However, it rolled out the HELOC product in Colorado, and is poised to grow that business. Let's look at the valuation. Upstart was a meme stock in 2021. Its share price reached $400 in that year, then had a dramatic drop ever since. At $22 per share, its price over sales is about 3.6, with a trailing 12-month sales of $500 million. That is inexpensive. Consider the price over sales ratio was about 5 for Equifax for a 5-year average. And it's a drastic reduction from 2020 and 2021. So the future valuation really depends on the future revenue. If the future revenue can reach $16 billion, then I think it's a $100 billion company. And current Upstart market cap is $1.8 billion. So can it become a 10-bagger to have a market cap of $18 billion? Considering FICO has a $25 billion market cap, I think that's possible. So really, the question comes down to, does Upstart have a good product? If not better, at least as good as FICO. I haven't seen any evidence to say Upstart's business model or key product is inferior, but obviously there are a lot of uncertainties in how its business will develop. So this is a extremely high risk investment, but if all stars are aligned, it will potentially become a spectacular, successful investment. Now let's look at Walker Dunlop. First, let's look at its capital market segment, as shown in the figure on the top right. The orange bars are the transaction volumes for the past quarters. So we can see in the third quarter, its transaction volume was about the same as the second quarter, which was a rebound from the low reached in the first quarter this year, but still drastically less than the previous 2 years. As a result, its revenue also stayed low, about $100 million, similar amount of level as second quarter and first quarter. Its EBITDA was negative for the third quarter in a row. That's because it's the fourth quarter in a row, its personnel cost is greater than the revenue excluding MSR. So Walker Dunlop's had a lot of brokers on payroll and have to pay them to keep them employed. So all the revenue in this segment basically goes to pay salaries and benefits. Obviously, this is a very extreme case. No business is sustainable to operate like this. So we should consider this as an abnorm. In 2022 and 2021, its segment revenue was actually $36 million and $85 million. So I would consider an average between those two probably is more of a norm for this segment. So for that to happen, we need to see the interest rate stabilizes and the transaction volume should rebound, as shown in the figure at the bottom right. This year, the multifamily loan maturity was $75 billion, and next year that will jump up by about 70% to $130 billion. So all those loans have to be refinanced or foreclosed. So that's a hope for a transaction volume rebound, especially if interest rate stabilizes. Although its capital market segment had a negative EBITDA, but fortunately it has some segment that is service and asset management. For this segment, its revenue, EBITDA, and margin have been very stable despite interest rate increase in 2022. This segment actually benefits from higher interest rate with $22 million of higher interest income in the third quarter compared to $26 million in the second quarter and the first quarter of this year. So if we look at the EBITDA, which are the brown bars, they kind of oscillate between $110 and $120 million each quarter. So I believe this segment has a run rate annual EBITDA about more than $440 million. And in the most recent quarter, there was no charge-off due to bad loans. Its corporate annual EBITDA was about a negative $120 million. So if capital market is EBITDA neutral, then the total company's EBITDA will be about 440 minus 120, give us $320 million of EBITDA. So that compares to $325 million EBITDA in 2022 and $310 in 2021. So that's a fairly conservative estimate with no credit given to its capital market segment. So at $70 per share, its EV over EBITDA is about 9.6, using 2022's EBITDA as a steady state. Of course, this year I consider as an abnorm, and the management gave an outlook of EBITDA would be down more than single digit compared to last year. So I consider Walker Dunlop's stock price is undervalued at this point. However, we have to be mindful of a key risk. That is credit risk, because Walker Dunlop has a credit exposure. So in the third quarter, it had an exposure about $12 billion and had an allowance for risk sharing about $31 million, but had no defaulted loans on book. That's because of the one default in the interim loan portfolio was sold with a $6 million charged off in the second quarter of this year. So how risky are its service portfolio? Its debt service coverage ratio is about 2.3, and underwritten loan to value about 62%, and 91% of its loans were fixed rate, and $3.2 billion of maturity over the next 24 months, not much. So those metrics portrays a financial prudence for Walker Dunlop. However, it's very difficult for me to have a confidence to know if there won't be any further default or just a distress in the loan portfolio. So I have to size my investment in Walker Dunlop accordingly. Illumina reported a disappointing third quarter result. So it's estimated the full year sales will be down 2.5%. That's a big departure from the initial guidance of 8.5% increase guided at the beginning of this year. That's due to the economic headwind as well as a transition from 6000 to Novasec X. So let's look under the hood of the quarterly figures by segment. So we can see that its quarterly revenue has been roughly flat since first quarter of 2021. However, its gross margin peaked in the second quarter of 2021, has been declining ever since, with the gross margin in the most recent quarter as the second lowest in the last 3 years. The reason behind it is explained by the gray bars, which are the consumable sales. So you could see the consumable sales peaked at the end of 2021, then declined from there with a slight rebound in the second quarter of this year that corresponds with a rebound in the gross margin. That's because of the product has a very high gross margin, over 70%. Novasec X requires different consumable from Novasec 6000. As a result, customers have been holding back ordering of consumables for 6000 as the number of Novasec X has increased. However, the ramp up is not as fast as the ramp down from 6000. Therefore, the consumable sales has been negatively impacted. So we can see a similar phenomena in 2017 with a dip in gross margin. That's because that's the year of Novasec 6000 launch. But interestingly, despite the subdued sales as well as depressed gross margin, its segment operating income has been holding up reasonably well, with the low reached about $200 million in the fourth quarter last year and the first quarter this year, and a slight rebound in the most two recent quarters. Of course, that's a significant reduction from a peak reached in the first quarter of 2022, over $300 million. But I would still say Illumina has a very profitable core business, even in a transition period from Novasec 6000 to X. So can the growth return? The key is with Novasec X, because it has a 2.x throughputs compared to 6000. So orders so far has reached 310 pieces of a machine. That's up from 260 plus in the second quarter. For the full year, the management expects a shipment about 335 units, compared to an estimate of more than 390 units in the second quarter. So that's a step down, and that's disappointing. The management attributed that to the difficult economic environment. However, to put in perspective, in 2022, Illumina shipped 340 6000. So most likely, the company will ship a similar amount of Novasec X in 2023. And total installed base for Novasec 6000 was 1,800 machines, with secular tailwind in genomic testing, the NovaSeq X may reach a similar amount of install base or even higher. So 340 is about 1/5 or 1/6 of future installed base, which is not that bad. Now let's look at the valuation levels. At $93 per share, its EV is about $16.8 billion, and EV over gross income about 6.1, as shown in the figure on the top right. That is a historical low. So the market is extremely pessimistic about Illumina. However, Grail has no gross income, and Morningstar assigns a value about $5 to $10 billion to Grail alone. So that's about half of the enterprise value of entire Illumina. For its core genetic testing business, its trailing 12-month operation income was about $870 million. So if we believe the core ops income is currently depressed due to the macroeconomic condition as well as transition from 6,000 to X, then that operating income should rebound. And if we believe its competitive position is still strong and its revenue will keep up with the secular growth in genetic testing, then its core ops income should not only rebound but to grow. If that's the case, we are buying a growth company with a good valuation and getting Grail for free. Another way to look at it is the enterprise value minus the value of a Grail. So we get a residual value of about $10 billion for the core business. So at a depressed ops income level, that gives us a EV over EBIT about 11. If we believe the ops income will rebound even without the future growth, then this is a very attractive price. Of course, we need to be mindful of the several threats I listed on this slide. The big one is forced Grail spin-off or outright sale to a competitor, and that may become a value destruction depending on the valuation level how Grail is disposed. And also, I'm mindful of my lack of understanding of the genetic testing market and the different competitive threats, especially from China. Therefore, my own conviction is not very strong, and I need to size my investment in Illumina accordingly. This concludes this episode of Quest for Twice. Until next time, happy investing.